You've probably heard of the movie Wolf of Wall Street, and you probably have a certain impression of what it's like to work in finance. So yeah, Hollywood high finance, actual high finance, kind of a different thing. Hi, I'm Gorick Ng, Harvard career advisor and recovering investment banker.
Recovering? Uh-oh.
And these are the unspoken rules of Wall Street. What does it take to succeed on Wall Street? It all comes down to a term that sociologists call studied informality. It means that you're able to apply this particular upper middle class way of speaking and conducting yourself that has you coming across as smart but not a know-it-all.
That means don't show off, just in case you're wrong.
Motivated but not threatening.
Don't go around punching holes in people's parachutes, basically.
And cool but not a tryhard.
Try hard not to be cool. Got it.
So these unspoken rules are unspoken. I mean, people talk about how it's important to have corporate polish.
Fleece vest, check. Pastel shirt, check.
Or it's important to have culture fit. Or as one person told me, you just have to get it. What does it mean to get it? Well, I remember one of my managers was talking to a colleague of mine and he said, I'll tell you when I see it. That's not helpful. But it really does matter. And it came down to me looking left, looking right, observing how people conduct themselves, and then emulating them accordingly.
If you want to be somebody, if you want to go somewhere, you better wake up and pay attention. Sister Act 2.
I remember it was one of my first meetings, and I was not expected to speak. In fact, one of those unspoken rules is to be
just like a Victorian child.
Seen but not heard. Or if you're on a conference call where you have the chief financial officer, the CFO of a company, and the head of your investment banking team talking on the phone, you have two people talking, and then you have like 100 people listening, all scrambling to take notes. So I was not expecting to be speaking at all until someone looked over at me and said, Gorick, tell me about those numbers. My heart sank. I was nervous. And so what I did was I ended up speaking at a mile a minute because I was so nervous that I just wanted to get the words out. And then after the meeting, my manager pulled me aside and said, Gorick, the next time you're nervous, speak half as slowly as you would normally speak.
Yeah, like how YouTube lets you adjust video speed. Yeah, you can do that IRL.
Now, if I'm observing a meeting and I see someone
speaking at the equivalent of 2x speed on YouTube,
chances are they're probably more junior.
Or the Ben Shapiro.
If I see them speak at 0.5x speed, chances are they're more senior. No one ever told me these things. I had to look left, look right, and see it for myself. One of the first things that I was told when I got my job on Wall Street is that this is actually not Wall Street. This is Midtown Manhattan.
Okay, then I'm definitely lost.
Wall Street has changed a lot over the last number of decades, where before it was in fact where all of America's biggest banks were headquartered. But after 9/11, these banks started sprawling their way across Manhattan and beyond. Now it's more of an idea.
Like the Tooth Fairy or Dollar Pizza.
Wall Street means finance. And if you're really an insider, it means finance. It means deals. It means transactions. So I still remember I was on my first week of training on Wall Street. We called it boot camp. The trainer at the front of the room points to me and says, "You there, what is the revenue of this company?" I had my Excel spreadsheet out. I looked at the number staring back to me and it said $3,000. So I thought, easy question, $3,000. I was told to speak confidently, and that's exactly what I did.
You guys remember rule 2, 45 seconds in?
And then the entire room chuckled. The trainer at the front said, try again and look at the label on that chart. I looked at the little tiny label staring back at me and it said dollars in millions. And I was like, oh, I get it now. It's not $3,000, it's $3,000 times $1 million, which is $3 billion. And this is not an amount of money that you just take out of an ATM. When we were talking about $3 billion, you're talking about buying companies, selling companies, deals, transactions. And so you end up with what people call on the inside, the buy side and the sell side.
All right, everybody, here comes your finance need to know.
So if you think about that Apple stock in your retirement account, well, Apple at one point in time had to hire investment bankers to sell pieces of that company, shares of that company, for you and I to buy. Now, it's not just you and I who own those stocks. It's the pension fund, it's your university endowment, and it's investment bankers who sell parts of the company that makes it possible for the rest of us to own a share in that company. And then you've got people who work in hedge funds, in private equity, in venture capital, the buy side. The way I think about it is, if you're on the sell side, you're making PowerPoints. If you're on the buy side, you're reading PowerPoints. When you're in a job where you're staring at $3, three and then a dollar sign, but it's actually $3 billion, you end up with high stakes, high scrutiny, high urgency, high stress, and probably high egos as well. Things matter when you make a mistake.
More money, more problems.
You move a decimal in the wrong direction, and you've got a massive problem on your hands that can get you fired, your team fired, your entire bank fired. In the financial industry, you also have two fears that plague everybody every single day. The first is FOMO, and the second is this nagging feeling that this doesn't really matter. Here's the reality. If a company like Apple is going to go public, so going to list its stock on the stock exchange for the rest of us to buy, you have deal makers who are all fighting to lead that deal. You really don't want to miss out, which is why if you're on the sell side, so much of your work comes down to pitching, because the higher ups are flying all around the world, having meetings, whining and dining with people so that they become top of mind.
No matter who pays the check, it pays to show your face.
If you're on the buy side, if you're buying companies or shorting companies, you have this nagging feeling that no matter how talented people say you are, that in reality, you're just lucky. And if you flipped enough coins, or if you had enough people flipping coins, eventually you're going to have someone who will flip heads 100% of the time. You'll look at that situation and think, no, they're not an expert coin flipper, they're just lucky. Now, if you think about the buying and selling stocks as this binary outcome as well, where someone is selling the stock for somebody else to buy, somebody's making money and somebody's losing money, it's so hard to deconstruct to what extent you were just lucky versus actually skilled in your profession.
Finance is gambling, and you need to stay lucky.
When you're junior on Wall Street, you get respect by being good at Excel. When you're senior, you get respect by being good with people. And the reality is, the higher up you go, the more you become a salesperson. The better you are at building relationships, the more likely you are to bring in deals. Because on Wall Street, you bet on a stock if you think it'll go up. You bet on a person if you think that they're going places.
So I'm told bullish essentially means optimistic about a stock or the market. So you're going to want to keep people bullish for you.
If you think about who is going to be selected for that next CEO role, it's not going to be someone who's going to apply on Indeed or on LinkedIn. That person has already been identified and is already being groomed. That's how things really work.
Be a people person, people.
Before I got my job on Wall Street, I thought that this land of Wall Street is this mythical place of sorcery. It wasn't until I showed up in my job that I realized that unless you're a quant and you're actually using calculus in your job, you know everything that you need to know from middle school math. But it's riled up in jargon that makes it incomprehensible to the outside world. So you end up hearing phrases like suggest operational efficiencies in the face of market headwinds. Not the economy's bad, so save more money so you have more money, and by the way, go fire some people.
In finance, it's not what you say, it's how you say it.
So there's an indirect way, and then there's how we actually communicate. I could still remember this one time I had spent all night on an Excel spreadsheet. My Excel spreadsheet had refed out, which no one likes in the financial industry. It just means that your model is broken and you've got this meeting coming up and you have no idea where those numbers even came from. I was sitting there stone cold because I was deathly worried that my manager's managing manager would look over at me. The managing director looks at the number, squints, and says, let's change that 3.4 to a 4.4. And I'm like, what? Like, you asked me for this sophisticated formula. I spent all night on this, and you just change a number like that? Career advisor and recovering investment banker. There's even a term for a situation like this. SWAG. Scientific wild ass guess. Nobody has the answer because finance is not accounting. Accounting is all about looking backwards at all the numbers that already exist and making sure they add up. Whereas finance is about looking forward, and no one has an idea of what the future holds. You have actually like 12 different ways of saying scientific wild ass guess. Projection, forecast, expectation, guidance, price range, price target, estimate, internal research, market sentiment, data-driven insights, forward-looking estimates. I mean, listen to some business news and chances are you will see one of these 12 synonyms and they all mean the same thing. And oh, by the way, when you have a bunch of scientific wild ass guesses together, you have something called a consensus estimate. All from the shamans of the financial system who are trying to predict where the future could be, when in reality, it's anybody's best guess.
It's not repent the end is nigh, it's reevaluate ahead of downward projection.
So is what separates those who are successful from those who are unsuccessful, does it all come down to just whether they're good coin flippers? Well, if you flip heads once, maybe you're lucky. If you flip heads 100 times over a decade, people start really paying attention. Confidence matters when you're in the financial industry, but confidence can only get you so far. Long term, it's about your track record that really matters. If you're a deal maker, what deals have you led? If you're an investor, what did you invest in? And how much money did you end up returning? Which is also why the people who tend to be the most well-respected on Wall Street tend to be those who are well into their careers. You may have some young guns flexing and talking about how much of a return they made over the last week, but time will tell whether they're actually these skilled or lucky investors.
Sure, fake it till you make it, but you've got to keep making it.
When it comes to competence, it's important to sound smart, but to not overshoot and come across as a know-it-all.
Well, there's that golden rule again. Studied informality.
I could still remember one of my very first job interviews was at a big bank. I was interviewing for the exact same role with the exact same interviewer with the exact same company as a really good friend of mine. He went into the interview room first and he came out sweating. Turns out he had received 5 back-to-back-to-back brain teasers. Those impossible interview questions where the interviewer asks you, how many burritos were sold in New York City in the last year? And what you have to do is look at the other person in the eye, keep a straight face, and do all this mental math and wizardry, all while staying cool. Meanwhile, I walk into the same room and we had just a great conversation for half an hour. It's important to come across as competent, yes, that, hey, you can trust me to be detail-oriented, to be quick on my feet, but moreover, I'm motivated to learn and we're gonna get along.
No, really, enjoy your interview. I mean, not too much. Be cool.
So banks come in all different shapes and sizes, but regardless of where you work, the hierarchy is generally the same. You've got analysts, associates, VPs, directors, executive directors, managing directors, heads of something, chiefs of something, including the CEO. And you might think that your life gets easier as you go up the hierarchy, when in reality, it's kind of hard wherever you are. When you have an associate job or an analyst job, rolls downhill.
Oh, what he means is, no, wait, yeah.
Someone, somewhere, a partner, a managing director, ends up selling the world and then expecting you to deliver on the world. That's when they're in your inbox at 5 p.m., just as you are hoping that you could go on that date, with this disingenuous phrase, hey, don't spend all night on this, but I need this by 7 a.m. the next morning.
Make the deadline, even if it takes you all night.
Now, at that point, you might think, gee, it's great if you're up top. Wrong. Well, number one, that assumes that you've made it to the top. It's hard to make it up to the top. And when you are up at the top, you're not just answering to your manager. You don't necessarily have a manager at that point, but you're answering to your team. You're answering to your clients. You're answering to your shareholders. So the reality is everybody has a boss. It just depends on what title they hold.
It's turtles, all the way down.
One key way that Wall Streeters demonstrate their commitment and compatibility is through the coffee chat. The coffee chat may or may not actually involve coffee, but it all centers around the same structure. It's a 30-minute phone call or in-person conversation where the first 5 minutes is all about the small talk, where you talk about where you're coming from and bonus points if you went to the same school, studied the same program, worked at the same prior firm. The middle 20 minutes where you flex your commitment and competence by talking about what you've worked on, all the research that you've done, how much of an interest you have in their job and their firm. The last 5 minutes are all about talking about next steps. And if you've done those first 25 minutes well, it will always end in the same manner, which is, hey, how about you send me your resume and I'll forward it along and we'll be in touch, which is code for ding, you've succeeded in your interview before the interview. And so before the process even kicks off, I'm going to get someone behind the scenes to fast track you to a final round conversation.
You could be in an interview right now.
That's how people get jobs. Sure, there's the portal, but there's also a side door. And those side doors come in these coffee chats. When it comes to this corporate polish, this thing that we can't quite put our fingers on, doesn't come down to just how you speak. It also comes down to how you look and how you dress. Things have gotten a bit more informal over time, as is the case with every industry. You went from suits and ties to suits without ties, to dress shirts with ties, to dress shirts without ties, to dress pants, to khakis. There's a uniform for Wall Street as well. In fact, insiders love to joke about it so much that there's an Instagram account called Midtown Uniform, where someone goes up and down the streets of New York and takes pictures of the current attire of Wall Street, which is dress shirt, khakis, and of course, a vest.
Invest in vests.
So yeah, there's a uniform. There's a certain way of dressing, certain brands that people will wear, certain styles as it relates to their collars and the fit and the fabric and the color that can mean the difference between someone looking at you and thinking, oh yeah, you get it, and someone thinking, you're trying a little too hard there, try again. Hollywood high finance is nothing like actual real high finance or high finance. Drugs, they exist. Coke, Adderall, all those things, yeah, they exist, but the data doesn't necessarily show that they exist more in finance than, let's say, in any other industry. However, the parties, yeah, they can get pretty expensive and lavish, but there are also a lot of nerds on Wall Street as well, especially if you're talking about the quants who are, again, looking at calculus and crunching numbers all day long. The reality of the job is, yeah, you're commuting to work, you're taking the train, you're walking down the street. You're not taking a private jet. Like any job, you're going to have good days, you're going to have bad days. And in the financial industry, so much of how much of those good days you have versus bad days comes down to who you work for and where you work. In fact, if you go on Google and you search for investment banking sweatshops, you'll get an actual list.
Oh, wait a minute. Hold on a sec. Oh, yeah.
And if you happen to work at one of these companies, you've got an instant conversation starter at every party as long as you hold this job. Because everyone's going to ask you, well, wait, you work there? Is it really as bad as people say it is?
Yeah, avoid the sweatshops.
But no matter where you work, your good days versus your bad days, they'll all follow certain patterns. What does a good day look like? Well, it begins the prior day, where you got home at a reasonable hour, and you looked at your calendar and there's nothing in sight, which means no fire drills, at least as far as the eye can see. And the eye can only see as far as the next minute, so it could change, but so far we're off to a good start. You wake up in the morning and no unread emails. Maybe in that case, you also realize that your manager is away for the summer. There are no live deals and things are a little bit slow. So you might go to the gym, you might grab an extended breakfast, you may even grab a coffee chat, and you might roll into the office at 9:30, 10 a.m. Check your email a bit. You show your commitment by asking if anybody needs help. Ideally, people say no. And your staffer comes along or someone you worked with previously emails you and asks you to update some numbers. It's a model that you made, so there are no skeletons in the closet that you know of or that you don't know of, which is the really bad part. And things are going smoothly. It's 5 p.m. and there are no fire drills. It's complete silence. You may even get to go for dinner. You then hang around and maybe leave at about 9 p.m. It's a good day. Now, what about those bad days? They start the day before. Maybe you were up the prior night until 4 a.m. Maybe you rolled into the office at 7 a.m. because you've got a conference call with someone in another time zone. Maybe you haven't even gotten to the office and your email inbox is already blowing up because that Excel model is broken, that pitch is getting rescheduled, that meeting that you thought was happening next week is happening in 15 minutes. Someone is calling in sick or has an interview or a coffee chat, but has a dentist appointment and you're taking over and you're feeling the walls close in on you even before the day begins. You're jumping around, from Excel spreadsheet to PowerPoint presentation to conference call to meeting, and everything is urgent and everything was due yesterday. And then you hand in your work and you're feeling triumphant, and then you realize it's another fire drill because it's hurry up and wait. Because this person that you thought would be available isn't available because they're on a flight, but you don't have time to commiserate over that. You've got another assignment that was already due 15 minutes ago. It's 5 p.m. You think the day is winding down. You get another email and another email and another email. You text your date. You say you've got to reschedule. You text your friends. You say you can't party tonight. And it's 9 p.m. and those automatic lights in the office start turning off because they assume that everybody's out of the office except for you. Half an hour goes by. You get a tap on your shoulder. Someone says, "Excuse me, it's the cleaning crew coming over." You swivel your feet to the right to let them in, to pull out the trash can from under your desk. They empty it. And while you're at it, you stand up and you wave so that those automatic lights turn back on. You grab some coffee, you go downstairs. The pitch deck isn't anything like what you had sent to them. It's delayed by several hours. Someone else is sending you an email now, even though it's 1:30 a.m. in the morning. People are wondering if you're still up. You've got to respond and say, "Yes, I am." It'll be in your inbox in 5 minutes. And before you know it, it's 5 a.m. and you're back in the office the following day. That's a bad day. If you're not doing those coffee chats and meeting those people and hunting for that next high-profile assignment, you may not hear about it up front, but you will find out about it. You'll get an email one morning from a colleague who says, "As some of you know, this is my last day. I'll be joining this firm starting at this time. I look forward to staying in touch." Here's the reality of Wall Street. You're always looking for that next opportunity. It's how the industry works. If you're in private equity, hedge funds, venture capital, your job is to hunt for opportunities. If you're a financier, no matter where you are, you're hunting for that next role, hunting for that next career building opportunity, hunting for that next foothold in your career. People are doing it. You may just not hear about it until it's too late.